one in the US, one in Europe, both seem like great businesses, and just wondered, why is one so much more expensive than the other? It's a real valuation puzzle, and honestly, it can make even the pros scratch their heads.
And that brings us to the big question, right? Why do we always hear that US stocks are expensive while European stocks are a bargain? Is one market just getting it right and the other is totally wrong? Well, the truth is a whole lot more interesting than that.
So let's get one thing straight right off the bat. This isn't about good companies versus bad companies. The entire difference, this whole valuation gap, it all boils down to one single powerful idea: expectations. And over the next few minutes, we're going to see exactly how that works.
All right, so to really get to the bottom of this, we need to make sure we're all on the same page. Let's start by breaking down the pieces of this valuation puzzle.
So when people say expensive or cheap, what are they even talking about? Usually, they're looking at a pretty simple metric called the price-to-earnings ratio, or PE. Just think of it like this. It's the price tag on $1 of a company's profit. The higher the PE, the more you're paying for those earnings, and yep, the more expensive the stock is.
And here's where you can really see that gap in black and white. On average, US stocks just consistently trade at higher multiples than the ones in Europe. But, and this is the absolute key, that doesn't automatically mean one's a bubble and the other's a bargain. Nope, it's a signal. It's telling us what investors expect to happen in the future.
So let's break down those expectations, market by market. First up, let's talk about the US story, and why it's a market that is absolutely priced for growth. The whole narrative driving US valuations is this story of relentless forward momentum. Investors see a history of explosive earnings growth, a culture that just lives and breathes innovation, and these tech giants that don't just lead, they literally dominate the entire globe. It's all built on this powerful belief in future expansion.
And what this really means is that investors are willing to pay a premium today for the huge profits they're betting on seeing tomorrow. So a high PE ratio, that's not some guarantee of success. It's just a reflection of sky-high expectations already being baked right into the price.
Okay, now let's hop across the Atlantic and look at the other side of this puzzle. The story behind the European markets is fundamentally different. It's not really about growth. It's all about stability. The European narrative is just, well, it's grounded in a different reality. It's a market full of established, mature industries, where the pace of growth is just naturally a bit more measured. Here, the big focus isn't on some crazy disruption, but on steady, predictable cash flows, and on rewarding shareholders directly with things like consistent dividends.
And this is such a critical distinction. Cheap does not mean bad. A lower valuation doesn't signal a low-quality company at all. It simply means investors have more modest expectations for what's coming next. And you know what? That attracts a completely different kind of investor, someone who really values that steady income and resilience over a high-risk, high-reward bet.
So when you put it all together, you start to realize something. You're not looking at one broken market and one that's perfect. You're looking at two different markets that are buying into two very, very different stories. This chart really lays it all out, side by side. Just look at the core themes. For the US, it's innovation and expansion. For the EU, it's stability and preservation. The focus for investors? In the US, it's all about that future growth potential. In Europe, it's about current income and being resilient. It's a story of disruption versus a story of reliability. Neither one is better. They're just two fundamentally different bets on the future. And hey, if you remember just one thing from all this, make it this. Markets don't price reality. They price stories about the future. They are literally a reflection of our collective belief about what's to come. And right now, the US and Europe are telling two very different stories.
Okay, so what in the world do we actually do with this information? How does it change the way we should think about investing?
There are two crucial steps here. First, you've got to avoid regional bias. Stop thinking expensive is good or cheap is bad. They're just labels for different kinds of expectations. And second, you have to understand the risk profile that comes along with each of these stories. Let's unpack that risk a little. In the US, those high valuations mean there's very little room for disappointment. If that big growth story stumbles even a little bit, the stock can take a major hit. But in the EU, with those more modest expectations, there's a kind of built-in cushion. That can offer a lot better protection on the downside when things, inevitably don't go perfectly to plan.
So the really crucial point here is that smart global investing isn't about picking a side. It's not about Team USA versus Team EU. It's about understanding these different stories and then building a portfolio that balances these different sets of expectations.
So I'll just leave you with this final question.
When you invest, are you buying a piece of a company, or are you buying the story that the market is telling about it? Understanding that difference, thinking in terms of expectations, not just simple labels, that is the key to unlocking a much smarter way to invest.